Arrived. We almost need to hone the concerns down, I think, to a manageable number. There is indeed a lot to worry about. I know it's early on, but let's go through them. We've got trade tariffs and sanctions that look like they are going to turn into full-blown trade wars. We've got an embattled German Chancellor and a German government that was, at least until last night, I think, at risk of splitting up over immigration. We've got Brexit and a weak UK government. We've got all the major central banks suddenly with some serious decisions to be made about interest rates, and in Europe's case, the winding up of its vast quantitative easing programme, all amid a slump in growth. I'm pretty sure we're not celebrating 1% growth, and populism showing no signs of abating. And just before we think, oh, I wish we could be more like the US, well, it's worth remembering that there, the average interest rates are, I think, still below 1%. Inflation is refusing to fire, and central bank balance sheets remain bloated. And on top of that, you've got a situation where, after years of intervention, distortion and tight regulation in response to crises, markets have been left weaker and more vulnerable than ever before. No wonder then that Algebris, the asset manager, recently launched an end-of-the-world fund in response to fears of institutional investors that another global financial crisis is on the way. The vehicle, officially called the Tail Risk Fund, will buy assets which should profit when markets crash or are hit with high volatility. It should be pointed out, just to be fair, that Alberto Gallo, who is in charge of the fund, does not expect the end of the world for at least another 3 or 4 years, believing that it will take that long for the anaesthetic of QE to wear off. I'm not so sure Alberto is right. Markets tend to act immediately. Just look at the taper tantrum of 2013, the China growth worries, sell-off in 2015, the end of the Trump trade correction in February, and most recently the severe volatility inspired by Italy's politicians. Well, I've gone through a few worries there, and to help me redraw this worry list and maybe even sort the genuine concerns from the mere bagatelles, discard the red herrings, but spot the elephants in the room, and to generally avoid any more animal-based economic metaphors, I'm delighted to say we have 4 capital market experts ready and primed to debate and discuss. Let's meet them, starting from my far left.
Okay, so I'm John St. Hill. I'm the Deputy Chief Investment Officer at Nest. Nest is one of the government-sponsored auto-enrolment providers in the UK. We're one of the largest DC schemes in the UK. We have about 6 million members. We currently manage about 3 billion sterling, but as a result of the changes in the legislation to minimum wage and to the contribution rates, we expect to be 20 billion sterling by the year 2021.
Robert?
I'm Robert Stheeman. I'm the Chief Executive of the United Kingdom Debt Management Office, which is part of the Treasury tasked with government borrowing. We've been around for 20 years. When the function was taken out of the Bank of England and taken back into the Treasury, and we're a small agency with a rather large balance sheet. And this, while I've been on many panels, this is the first time I've been on an end of the world panel.
Welcome. A warm welcome, Andrew.
Andrew Milligan, Head of Global Strategy at Aberdeen Standard Investments. Standard Life was set up, I think, in 1824 from memory, or thereabouts. So we've survived almost 2 centuries of all of the difficulties which you've just been explaining. So we're a big global fund management house, about $700 billion, pound, not quite sure which, of assets, 50 countries across the world, every single asset class that you would want to cover. My particular role, we carry out the financial markets research, we take the tactical and strategic asset allocation decisions, and then we tell the rest of the fund managers and our clients what's going on in the world. So I look forward to learning.
And thank you, Toby, for inviting us for this doomsday start of the 2 days conference panel.
Let's see where we are at the end of this panel. Maybe we'll all be much happier. I don't know.
Jean-Marc Mercier. I'm a global co-head of debt capital markets at HSBC. I'm also deputy chair of ICMA, so on the board, and looking forward to this panel.
Good.
And just we were founded in 1865, so we also survived a few years at HSBC, but absolutely looking forward to the panel.
Good. we're going to have hopefully a bit of time for questions at the end. And I don't know whether any of you have downloaded the Euromoney Conferences app, but on that app are some questions that I'm hoping you can answer. I've posed one on the app, which is under live polls. If you go to the app, it's under live polls, and it's Rethinking the Risk Landscape in 2018, polling question. And if you look at that, I've given you 10 worries, and I want you to choose which one is the biggest worry, please. Have a look at the app, and then maybe, if the technology is working, we'll know at the end how we're doing with that. But let's begin, and I'd like to start talking really about global markets and central banks. And I know that we've just heard from Tim about how difficult it is to predict and what a dangerous game that is. But I want to start off with one predictor, which is a yield curve, the yield curve. And history tells us that flat yield curves and then inverted yield curves presage severe problems for economies, such as recessions. The last 2 times we've had inverted yield curves were just before the dot-com bust and then the great financial crisis. Andrew, let's start with you. Why do we have a flat yield curve, and should we be worried about it? Can we expect the hat trick of predictions in that respect?
I think there is great debate about why the yield curve is currently shaped as it is, if you wish to get into technical aspects about term premium and such like. But let's say the long end of the curve is not yet convinced that inflation or growth will pick up quite to the level which the Federal Reserve is suggesting it might. And therefore, with considerable demand from a number of the I suppose this end of the panel, the people who are actually buying on behalf of clients, despite the issuance from that end of the panel, so to speak, that demand is definitely keeping yields down. But I was actually going to come out with a prediction, which I know is always dangerous. Tim made the excellent point that the average probability of a recession happening in any current year is 12%. But I think we do have to worry about the probability of a recession in the United States in 2020 at being, let's say, 24 or 36%, i.e. a noticeable step up, because that is the year where the US fiscal stimulus will be beginning to fall away, and if we do think the Federal Reserve is going to be raising rates, the tightening will inexorably build up the debt problems. So it's the first year, I think, where we can say to ourselves, putting aside all of the political risks and the China debt risks and such like we'll talk about, actually we should be assuming a noticeable slowdown in growth anyway in the United States, putting aside any other stimulus packages, and therefore the probability of a recession, all other things being equal, should be rising. Now, it's obviously not above 50% yet. I'm not yet being sensible and going logically to the end of that argument, but 24, 36%, that does affect. In that sense, the flatness of the yield curve is already beginning to give us warnings about the future risks, even if it's not yet inverted, to start saying, a recession really is on the horizon.
John,
I mean,
as an investor?
Yeah, I think it's a fair point to say that there's a heightened risk of recession in the US in 2020. There was the Wall Street survey which came out a few months ago, saying that 60% of Wall Street economists forecasted a recession in 2020. I think in terms of the yield curve, though, at least with the UK, I think a big chunk of the shape of the yield curve historically, or at least since some minimum funding requirement, has been due to the demand in the pension fund space. I think we still live in a fundamentally different environment because of the need to make the pension promise sacrosanct. If you have a situation where corporates are making an absolute promise, then you have to find some way of discounting that absolute promise at a way which makes it completely certain. And the only effective way to do that is with long-dated gilts or with long-dated swaps, and that's necessarily going to cause the yield curve to flatten. I think as well, when you start to see the sort of a demographic change as we become older, that will necessarily sort of spur increased demand at the longer end of the curve. And then, of course, you have the actions of QE, which have, to some extent, unwound some of that natural flattening that we've had, and to the extent that in the future, the UK Central Bank decides to unwind QE, that could well bring us back into a flattened yield curve, which wouldn't necessarily spur an inflation signal. It could all just be a large component of the flatness could become an issue of supply-demand.
Yeah.
Okay. Andrew hinted at this, Jean-Marc, about rising rates. Can developed economies cope with a rising rate cycle, Jean-Marc?
Well, at HSBC, we believe it's going down, so it's a bit difficult to answer your questions. We still believe 10-year treasuries should go back down to 2.3.
Okay.
Pretty much an outlier, but Steve Major, our chief strategist, continues to be on that path. And I think John nailed it. I think whether it's QE or whether it's demographics, I still believe he's right, and we will see 2.3 before we see 3.5. So we continue to be quite bullish. And again, QE is unprecedented. This was an experience that we probably have a unique experience to see. We don't really know how we are getting out of that. We don't really know the effects of it. But I think, John, I totally agree. I think QE and demographics, the other massive trend that is beyond the growth of GDP for this year or next. These are the two biggest elements to explain what we see now.
Yeah.
If I remember rightly, and forgive me if I'm wrong, one of Steve's reasons for having such a low Treasury forecast is his really quite downbeat views on inflation compared with some other people. I think, running out for the next couple of years, we are in a very difficult situation. We all know the structural issues that have been restraining inflation, globalization, etc., etc. Nevertheless, anyone who's thinking at all in hockey stick terms, what's the shape of the Phillips curve, etc., and we are starting to see some inflation pressures in parts of the United States. I mean, the German labour market, for example. So, I mean, there is a big debate here. I'm not saying Steve not saying Steve's wrong at all. He's entitled to his views. He's wrong, but he's entitled to his views.
He's been right for 4 or 5 years.
Yeah. So the inflation outlook over the remainder of this cycle is absolutely fundamental, and just because we know what's happened in the last couple of years says nothing about the risks of the next few years.
Yeah. So, I mean, Jean-Marc, were you surprised by the ECB's announcement last week that its stimulus program, 2.4 trillion stimulus program, will indeed come to an end by the end of the year? I should point out, though, that Mario Draghi said he would be looking carefully, in his words, at incoming data and medium-term inflation outlook. Were you surprised, though, that his announcement came last week?
Look, I mean, Draghi has done a fantastic job, and we look at late October 19 when he goes, and we'll be reflecting how much he did for Europe and for the world in particular, but certainly for Europe. And so these guys at the board of the ECB are doing a fantastic job. And actually, I'm quite worried because Pratt, Curry, and Draghi are leaving from May to December. So these are the three very visible board members. There are others, obviously, board members, but these are the three that were there for the last few years, who've taken us through this QE experiment and successful work through, and they are leaving us. No, yes or no, I was not surprised in particular. I think he did a very very good balance, to slow it down in a very gentle manner, having a lot of words to make sure that we don't go anywhere like bearish. He's done a good job. And the markets have taken it very well. And we need a bit of optimism to be able to finance the economy and finance our sovereign clients, finance our corporate clients, finance the banks to continue to do what we have to do.
Or put it another way, there is quite a risk with the ECB changes in 2019, how hawkish or dovish they are, how Germanic or southern peripheral the leadership of the ECB becomes, which I think could have major implications for European markets.
But I mean, the thing is, 3 weeks ago, it's only 3 weeks ago that we were all transfixed by what was happening in Italy and wondering whether Europe was facing another existential crisis, and the end of QE, I think, looked a very distant prospect. I mean, the people I spoke to said that QE would actually have to last forever in Europe, given the way that politics, or rather democracy, would continue to throw up these challenges to the European Union. I mean, I know the ECB, you say, has done a good job, but I still really question the timing. I mean, do you think it was a bit odd?
I don't think it was. I don't think it was odd. I think almost the ECB had to proceed because otherwise it would have shown that there was a put, so to speak. Italy's a worry. We can't change monetary policy. So I think the ECB almost had to go down the lines of keeping to its growth and inflation forecasts.
Yeah.
I absolutely agree with you. You know, all of the worries that we've had in recent years about the Dutch elections or the French elections or what's happening in Spain, Italy is the weak spot of the European Monetary Union. I mean, there's just no doubt about it because of the size of the debt mountain and the fact that we still do not have the bank deposit insurance and the Eurozone bond sovereign debt issue sorted out. So if Italy becomes an issue, it becomes a major issue for the future of EMU.
Yeah.
It always has been and will be until the structural system is sorted out. So either autumn this year, summer next year, I think is a big risk for financial markets as the fiscal debate between Brussels and Rome picks up.
Yeah.
But Toby, you spoke about the US, but I think Europe in the next 18 months is going to be very interesting. If you do it from what we just discussed, so the last quarter of 19, you have a change at the helm of the ECB. I start in May, right, with Pratt, but so we don't know who's going to be at the helm of the ECB. But before that, you have the late May 2019 European Parliament elections. That's interesting for two reasons. One is because maybe we get a Eurosceptics parliament.
Yep.
We don't know. I haven't seen really a lot of polls yet, but it's a bit early. But also, Macron has been walking on water, and in May 19, maybe En Marche does not win the European elections, and so his power, if you will, to basically change Europe, to reform France, might dim. That's not my central scenario, but that's a risk. And before that, we are 20 minutes, March 19, we don't really know yet how it works. For 29th of March 19, Brexit, right? So there's a lot of things, and obviously immediately, as we discussed earlier, Q4 2018, well, the last 15 billion are being purchased, and then we run out of that. So there's a lot of things happening in Europe in the next 18 months.
Yeah, good point.
Yeah. Just moving on slightly. Actually, sorry, Jean-Marc, I just want to go back to. I mentioned that it was only 3 weeks ago that we were all terribly worried about Italy. Do you think, I mean, we seem to have a calm now. Do you think that calm is justified?
Look, it's very difficult to price, as we have seen before, it's very difficult to price political risk. Basically, you cannot. So we have to take maybe with a pinch of salt what they said. They're not anymore like we want to go out of Europe, we want to go out of the euro. Now it's a bit more, well, we have to reform from inside. So I think it's what they say is looking pretty good compared to what we feared. Yeah. But also we need to see what they do. I mean, the examples of Greece where Syriza was a bit of the wolf, and in the end they played ball and reformed their country. Let's see what the Italians, the new power, do. It's a bit early to think. But also we need to think about Spain, where we were happily surprised that over a few days there was a change of side and extremely Euro friendly government with statements, with actually physical statements, having the staff coming from European officials and all that kind of good stuff. So, I would focus actually on Germany. What's happening now is like, well, hold on, we had a big anchor for the last few years, in 2008, in the 12, 13, 14, we had a big anchor in Europe with Mercier and her government, and at the moment it's a bit shaky.
Yep. Okay.
But I think part of the problem is, and this is speaking with our clients in America and Asia, European politics are so complicated, it's perfectly understandable why a number of American and Asian investors are saying, why invest in Europe? It is just so very, very confusing. Let's keep with the areas that I know. And so it's encouraging them to keep their money at home and not investing in European assets. That, sadly, is the result of the flows data of recent months. And it's understandable. It may not be logical or sensible, but it's understandable.
Yeah. But it's turning on its head, though. Should we actually, in fact, be celebrating the end of QE? Not only does it supposedly represent a recovering European economy, but also it is perhaps a tacit acknowledgement that the stimulus policies had begun to do more harm than good.
No, I think we should. I mean, the world economy has now grown, pretty steadily since 2008, since 2009. We are seeing unemployment coming down, inflation picking up, governments generally getting fiscal policies back into some semblance of order. Okay, it's a long drawn-out process. I think central banks are quite right. Put another way, they need to start raising interest rates up to some sort of normal, natural terminal level to have any opportunity of reducing them as and when the next downturn does come. Now, we could argue that central banks might have actually moved faster with tapering or interest rate increases, but we are where we are. So I think all well and good that they're actually... Central banks have been manipulating financial markets for quite a few years now. The less manipulation they have, the more opportunity for financial markets to do their job of allocating capital sensibly, the better.
Yeah. That's a really interesting question, actually, because and I think this applies as much to the gilt market in the UK, the little gilt market, as it does to Europe, to the US. So QE, as far as I am aware, was at the time when the major central banks embarked on it, nearly 10 years ago now, was viewed as a temporary measure.
Yes.
And that's why it's very interesting to hear comments from some people saying, well, maybe it'll go on forever, who knows how long it'll take. The notion that actually some kind of withdrawal from QE can happen, I think is indeed, to answer your question, I think it is actually a positive, simply because it suggests not so much a return to normality. I don't even know what normality in that sense is, but it suggests to me that more conventional tools might be available to policymakers than have been so far available. I also happen to think that actually some form of a reduction in QE, and again this applies to all the major markets, not just the one in which I operate, but some kind of reduction is actually quite healthy for the market. It's quite good for the market. What it means is that markets will have to reprice at different levels. That's not a bad thing. But what I find interesting is Jean-Marc's comment about where HSBC is on some of this in terms of also forecasting where you think yields might be. And I'm not saying that I have no idea whether it's right or wrong. Actually, I have a lot of sympathy with some of the thinking behind that. That suggests to me, what you were saying, is that actually an unwind of QE in the US on a significant scale doesn't right now seem that close.
And we should not forget the Bank of Japan is still carrying out QE and looks to be for the foreseeable future.
I mean, to the extent that these programs are coming to an end, I mean, I agree with you in that what it signals to the market is, the policies by and large managed to stave off, a second Great Depression, and by trying to sort of normalize central bank balance sheets and take steps towards normalizing interest rates, it sends a signal to the market that there are some tools left in the box to try to address the next slowdown, which can only be a positive thing.
Okay, just moving on a little bit to trade tariffs, and it's in one of my 10 on my worry list anyway, on the app. But I'm just wondering, can we put a number on this? I mean, how far up the worry list are trade wars or tariffs when talking to your clients, Andrew?
It certainly is something...
Slightly nebulous at the moment, isn't it?
It's certainly something they wish to talk about, but the issue is, as everyone knows who's looked at the figures, the excellent forecast from Steve on this from HSBC. Currently, the figures are at the equivalent of 0.1% off global GDP growth. I mean, it's rounding error type stuff. A 50 billion and 100 billion, I mean, these are not large enough figures to have a material impact on the world economy, and it's really just minor movements in financial markets, therefore. The worry is the future. The worry is, A, do we have tit for tat, 100, 200, 400, 800, and so it explodes? And secondly, and I think G7 was spellbinding in that context, America is changing what the rules-based global trading system looks like in front of us. and we're not entirely sure what the new setup is going to be. Is it going to be a series of bilaterals? Is it regional trading blocks? How does China respond to this? It's those unknowables that will be material for growth and markets, not 50 billion, 100 billion, which are obviously unfortunate, but at the end of the day just will not change the dial on Steve's forecasts to any great extent.
You expect it to hit your business, Jean-Marc, bond-raising business?
Well, I mean, as we can see from the markets every day, when we have that kind of news, the market is a bit tricky the next day or two. So for sure, but I think it has been the theme of the last year, going into 2018, or something either with Q2, or it started really in February. I mean, January was unbelievable. If the Oman DMO could raise 6.5 billion in January, I don't think they can do 6.5 billion now. So the market can find great windows, great time, where you can do the biggest book ever for the UK DMO syndication. Right? So if you find your right windows, you can do, but on the day after, we slap potentially another 200 billion of tariffs, which is probably, 250 is probably half of the export of the US. So it starts to be meaningful, but difficult to grasp what the impact beyond, I'm a simple man, beyond tomorrow execution of a funding for a client. But it adds to your top 10 worries. I hope you sleep well.
It deserves to be on there.
Oh, certainly.
I've got 8 or 9, not 10, but...
Okay.
I think, when I was sort of learning Finance 101, I got taught there's only a couple of free lunches, diversification and comparative advantage, i.e., specialization and trade. So, there's no scenario, I think, under standard economic theory where increasing tariffs and tit-for-tat responses is likely to improve global GDP growth. The question is really how much of a reduction in global GDP growth it will bring about, not whether it's a negative impact or not. I think something which is a bit more of a concern is the extent to which the inability to move goods across borders interrupts supply chains and actually creates extra costs, not just from the tariff itself, but from the interruption of the global supply chain and the inability to produce goods just in time for consumers.
Good point.
Okay, so we've briefly discussed the Fed raising rates in the context of developed markets, but and Jean-Marc, I'd like to ask you this: what about the emerging markets? A strengthening dollar is surely going to make life a lot harder for emerging markets, whether we want to hear it or not. It's true, right?
Yeah, look at we call it the original sin of emerging markets, the dependency on dollars and certainly dollar funding and the cost of your funding. If you borrow at some rate, you have to pay back at a silly rate. We've seen the Eastern Europe mortgages, right, in Swiss franc. So, yes, it's a worry. Dollar has been strengthening a bit. Do we see it go much higher than that? I don't know. I think I don't have a general EM worry. I think we have some situations, for sure. But you also need to think that some of those situations, they have been turning out pretty well. They have been funding themselves at pretty good rates. So it's not an immediate worry. Clearly you have one country, Argentina, to name it, that was coming out of history. So it comes a bit early, and it's interesting to have the IMF come in, think of the past, to actually help, Macri and the country to go through that very tough patch and potentially accelerate. The question was the pace of reform, right? So if that helps accelerate the pace of reforms, it could be a tough one, but actually a good one. But many other of those countries actually benefit. I think oil is a big element. You talk about the dollar, but oil and the terms of trade, oil low, oil high, it's a very different ball game for some of those countries who are importers or exporters. And my worry is more the speed at which things move than where it is, in a way. At 25, some people have it tough, but others actually benefit. At 100, the other way. And it's actually the speed at which it goes there or back, which I think for me is a worry. It's not whether it's there or there. It's really, you need to adjust whether you're actually a corporate or you are a sovereign. You need to adjust your finances, your social cover. We've seen the Middle East, I mean, it has done whatever, 25 billion of issuance for sort of 7-8 years since the crisis, to raise more than 100 billion in the last 2 or 3 years, 120 billion in the last 2 years. So, I mean, it's a massive shift of dynamics, and it's not just, it's the speed at which it happens. You can move your policies, but you can't move like overnight.
And I think the extent of local currency issuance now compared to, say, 15 years ago is much greater. So the immediate threat of sort of changes in dollar exchange rates, I think, is a lot lower. And from an asset owner perspective, over the long term, more than a third of global GDP comes from countries with a GDP per pop of less than $17,000 per head. So to put that into context, you've got a big chunk of global GDP produced in countries where there is a lot more scope for actual GDP growth and wealth improvement in citizens. And then these countries tend to be younger. So yes, although these short-term issues, the context of 2018, may be sort of very much to the fore, over the long term, I think emerging markets are likely to play an important role within asset owner portfolios.
Yeah, Robert.
I was just going to say, I would be less worried about a rising US dollar in terms of the impact on emerging markets or for emerging markets, as I would potentially by a significantly increased US deficit potentially occurring at the same time as some kind of monetary policy tightening. Because I think that could have
Which is where we're headed.
One never knows, but it could have a major impact on global capital flows, which will then potentially hurt emerging markets first and harder than it will the developed markets.
Yeah. You summed up very ably in 1.5 days of discussion we had about the dollar at our asset allocation meeting the other day. The cost of the dollar, the availability of dollars, supply versus price, so to speak. I absolutely agree with you. If the US deficit explodes, dollars flooding around the world, emerging markets are fine. But of course, that's not what Mr. Trump wants. Mr. Trump is actually make America great, means tackling a lot of those trade deficits and bringing them back down. So this is where we have quite a difficult issue facing us going forwards. The cost of the dollar, availability of dollars, dollar liquidity, dollar interest rates and the dollar exchange rate. 3 related concepts. And then, I absolutely agree with you on emerging markets, putting aside China debt, which I'm sure we'll turn to as one of the risks shortly.
And actually, a lot of sovereigns have been pretty aware of that. And in EM, a lot of those have been trying to develop their local market.
Yes.
Doing, Peruvian soles for the Republic of Peru, or doing, local issuance, the Komodo market out of Indonesia, you see Masala out of India, whether it's the MDBs like IFC or others trying to help spur it, or the local authorities trying to really create a local market. The Mexicans have been trying to really develop the Mexican peso. Sure. So they are aware.
I hear what you're saying. I agree that there is momentum, but whether or not they've done enough to avoid the problems of borrowing too much in dollars for when dollar rates go haywire.
As long as the US doesn't enter...
They're better than they were 10 years ago, but not good enough yet.
As long as the US doesn't enter recession, the growth dynamics will support. If the US enters recession, then they are in difficulty. Yeah. That's because their ability to find the dollars they need to repay, or the local the impact of a US recession on their local economies.
Yeah.
And in Asia, the development of the markets we have seen really Asia finance Asia. Right? So we do Reg S issuance.
Yeah.
And the wealth creation there is funding the future of that region. So you don't really need to do 144A and go and get the money from the US. It's actually now self-funding. The growth of the wealth has been so massive compared to the rest. I mean, the growth in that region has been fantastic. So actually, Asia is financing Asia. It doesn't need dollar, US dollar from the US, if you will.
Sure. I mean, John, you mentioned it, I think, but Jean-Marc, I mean, as a house, you are obviously very pro-emerging markets, and actually, for you, the optimism outweighs the pessimism, doesn't it, on emerging markets in a sense? Demographics from that side.
We publish research 2050, how it looks like, and the massive, perennial trends clear.
Yeah.
It's demographics, it's urbanization. I mean, the development of the wealth, the middle class. We all know it's coming.
Determination.
We've seen it. It's absolutely clear. Yeah. And that's a very, very strong positive. Except it's probably more positive for equities than it might be for fixed income. But it's still a very, very strong trend in the next 20, 30 years.
And tactically, do I buy today?
That's right.
Or hold off?
Yeah, well, that's the thing. Can those qualities outdo the short-term pain that these countries will surely feel as the Fed pushes up rates? I'm just wondering whether we could show the results of the poll so far. Can we maybe move off the bow tying, which I'm sure is, there we go. So at the moment, what should we be worrying about? European politicians.
Asset price bubble bursting. Yes.
Yeah, and then banks and markets weakened. So those are our three major concerns there at the moment. Okay. Keep on voting, by the way. If you haven't voted, do please do so. Just want to move on to liquidity and credit concerns. And Jean-Marc, I'd like to ask you to start us off here. But do we have liquidity concerns despite supposedly shoring up liquidity concerns at the end of the crisis 10 years ago? Or the last crisis was about liquidity. Where are the hotspots now? Do we still have problems?
Yeah, look, I mean, for me, the GFC was about three things: liquidity, or lack of that day. It just dried up quite quickly. Yeah. I think the maturity transformation, so lending at 40 years when you were borrowing extremely short term, basically a few months, and also credit quality. So where are we on those three things? Well, the end of QE might be a liquidity problem. Yeah. And it's not so much, I mean, basically we're back to normal, so we shouldn't be worried, but from being on liquidity on tap to a more normalized, it's probably going to be a bit tricky to adjust. It shouldn't be a problem. I think the transformation of duration, or rather the maturity, that's absolutely happening on this market.
So coming back again.
I think what is happening is really on the funds side, where you have a daily liquidity promise. So that's a worry. But clients have backup lines to make sure that they have enough liquidity, or you can gate if really terrible things happen. Credit quality is very difficult because it looks great, but that can change relatively rapidly if you have some recession coming, for example. So, I mean, those three, I'm relatively, cautious. Let's call it that way. Not now.
Of those three, what's the biggest?
No, I don't think it's just all three. One of them is not a worry in a way. You see what I mean? Right? It's the three of them coming through.
If you go
That's
back,
a classic as well. Sorry.
Not at all. If you go back to those three leading questions that are there, one of them is asset price bursting, which is another way of saying there is too much liquidity. Yeah. Prices have been inflated, and now liquidity is being pulled away. I mean, why else is the central bank tightening, but withdrawing liquidity, so to speak? So yes, there is a question about it hasn't too much liquidity being thrown out into the world economy through QE or whatever other techniques you wish to say, and presumably that's the logic of that asset price question. I think if you think about liquidity in some other areas, though, one would have to say, as and when people wish to start taking profits and run for the exit, aren't there going to be difficulties in some areas? The whole ETF passive exploded in the last decade. What's going to happen there? But in active funds as well. I mean, we saw, around Brexit, UK real estate funds, liquidity suddenly drying up there. And you know, your point earlier about DMOs only able to issue on certain days of the year, so to speak, liquidity in markets for issuance is well, you know, the expert is sitting beside. So liquidity being withdrawn, asset price bubbles, but I think already we're seeing on certain occasions the early warning signs in credit, private markets, infrastructure, whatever it is, about people wanting to sell and realising they can't.
Do you think the mechanism has changed? As in, it's much easier to sell and faster to sell, and therefore the spikes in volatility of that they're all much greater.
Yes.
Yeah.
I think there's also so I come at it from a slightly different point of view because of what I do for a living. But it isn't just a problem with the easiness of being able to sell, but from the point of view of an asset owner trying to buy. You know, one of the things we try to do is we try to use credit in order to create some incremental yield on the portfolio, and because of the increasing cost of regulatory capital on the sell side, it is much harder to put to work large amounts of money in the credit space because basically the sell side isn't able to just offer you a two-way price and just fill that trade for you.
Well, John, if you want to buy, come and see Mummy. But
And on the plus side, we might have a bit of liquidity returning because of the softening of the Volcker rule, for example.
But Toby, I think it's very interesting because somehow we are all like crying wolf and we're all thinking, well, Volcker rule is like being, let's call it dusting off. But maybe the guys who are spearheading this think we need this capacity from the banks to actually trade and be able to buy when people want to sell or sell when you want to invest, right? So which the last few years, clearly it's a bit tricky. Huh?
So let's put it.
Hang on, yes.
I was going to say this. There's also a point that you can always get liquidity. The issue is at what point what are you willing to pay for it? So somebody will always offer you a price for something. The question is how wide is the spread and how much are they going to charge you for renting the balance sheet?
I was just going to make the point, is it too cynical of me to think that the US budget deficit is about to double or triple in size over the course of the next couple of years, and it's easier for US investment banks to start dealing in those markets? I mean, is there any link between the two?
Yeah,
It's a rhetorical question.
Yeah. So let's just move on a little bit. We've touched on it with banks and their support of markets, but I'd just like to talk about another risk, which is regulation or perhaps even the over-regulation of the banking sector. And Robert, I think I'm right in saying that as of May the 1st, asset managers must now show the top 5 brokers that they have used for trading over a calendar year, including bonds. This is part of the drive for transparency, otherwise known as MiFID II. Is this good news for you, for the bond market, Sir Robert, do you think, as a leading issuer of bonds? How much have you issued this fiscal year so far?
We're about just over 20 billion, so we've got 100 billion, just over 100 billion in total. So we're sort of steady as she goes. That's a really interesting point. I mean, you touched on regulation, MiFID, and specific regulation. Regulation is an interesting thing, and of course, I'm very conscious that what I do, and I work in part of the financial authorities, so I will be very circumspect in making any criticism of regulation, or let me rephrase that. I'll be very circumspect in making any criticism of the regulators. Regulation is an interesting thing, and I'm slightly in two minds. I mean, it is obviously something that is necessary. And in fairness to the regulators, what they have probably tried to do for the last 10 years is to make the overall system, one way or another, safer. My concern about regulation is twofold. One, it is, as I've always referred to, the law of unintended consequences. A lot of regulation is put in place for very valid, perfectly reasonable causes, but actually sometimes it can have an effect which was simply not intended, and that cannot be foreseen. And if you have not just one single piece of regulation, but numerous pieces of regulation, the cumulative effect of that can be quite substantial. Not a specific piece, but the cumulative effect of regulation. Now, you referred to MiFID specifically in one particular thing.
Yeah.
But let's
It's gone under the radar.
which has gone under the radar, and I think it's actually a very important one. And what I find worrying about that, first let me talk about why do I think that's worrying. It's because those people who are best able to deal with regulation tend to be the bigger players, actually.
Yes.
They're the ones with the biggest capital, the biggest resources. The ones who are rarely affected by regulation are the smaller players in any market. If we are worried about the cumulative effect of regulation, it will squeeze the smaller players.
Yeah.
Your example, for instance, on MiFID. This goes back to my point about unintended consequences. I just ask the question rhetorically, are regulators really comfortable with the notion that they are squeezing out the smaller players and perhaps inadvertently causing greater concentration in the market, especially among the largest?
I would absolutely concur with everything you've said, and the research side, we're already seeing. The amount of money being spent on the smaller brokers, the ability of smaller independent houses to provide research is clearly a world different to what it was 12, 24 months ago. My only other comment on your excellent remarks would be, I think Brussels was told in no uncertain terms over the course of several years about MiFID, PRIPS and KIDS, and to still proceeded. So, hence the FCA, coming out the other day with its statement. But Brussels cannot say it wasn't warned about some of the foreseen consequences, which are pretty much appearing, just as people said.
And one other quick comment on regulation, which is something I think people might occasionally forget, and that is that regulation can only ever support and promote minimum standards. It cannot actually enforce maximum standards. And I think that is something which perhaps every regulator should sort of, I always think above their desks they should have this big sign, "Thou shalt not cause unnecessary harm."
Yes.
Okay.
Yes.
Jean-Marc, I don't expect you to comment on this, but Sir Robert, if I can maybe get you to carry on a bit here. But so these regulations suggesting that intermediaries are being squeezed. We at GlobalCapital hear it every week. Margins in the bond markets are being eroded. Has this squeeze directly hit you as an issuer in terms of the service that banks are offering you?
I'm going to take that question. I'm going to slightly turn it around. I mean, it's a really important one. I think some of the margins are being squeezed. I think regulation plays a role here, but actually now I have to say I don't think it is just regulation. One of the interesting things about the markets in which we have to work and we have to operate, fixed income markets, is that actually the barriers of entry are remarkably low. This has become fixed income, especially in my market, sovereign debt, is a very commoditized market. You have many different choices of people with whom you might want to trade, with whom you might want to deal. On one level, that is fantastic. So and I'm assuming something here about the investors on the panel, actually you might be enjoying remarkably good liquidity in inverted commas. I'm not quite sure it's real liquidity, but good pricing perhaps, generally quite good, thanks to people like Jean-Marc who are offering that. On our side, and you referenced a recent syndication which the UK undertook, clearly we're also seeing good demand and good pricing. Now, if I'm happy, and if you're happy, someone in the middle probably isn't quite as happy as he or she should be, which to me suggests that there is an issue around, again, not just margins, but actually participants being squeezed significantly perhaps. That, in the short term, is bearable by intermediaries. In the long term, I wonder whether it's that easy to bear, simply because actually margins are the thing of which you have to live from.
And if I remember right, the investment bank share prices are down this year. Trading volumes and the
European
margins.
ones, you mean?
And US as well,
And
I
US.
think. Flat yield curve, of course, not helping.
So, I mean, this must be seen as a risk, but is a wave of banking consolidation inevitable in Europe?
I'm going to jump in on that one, and I would say I personally believe there will be a wave of banking consolidation. You can leave out the in Europe bit, period. I think globally there will be a wave of banking consolidation.
Yeah, but not necessarily happening for the right reasons.
Well, on the one, you could also say that actually real consolidation, even if it's painful, might actually, in the longer term, provide a more robust market. Consolidation itself is a market phenomenon.
Yeah.
But I mean, the technological trends that we're talking about that are underpinning that are global. I mean, okay, parts of Europe are overbanked, say Italy, for example, Germany. But I mean, the digital trends that the UK is facing are absolutely, I mean, fintech is across every part of the world.
Yeah. Yeah.
So deposit gathering, stroke microfinance, crowdfunding, and these are phenomena globally which are affecting banks. So I absolutely agree. We will see consolidation everywhere.
Yeah, Jean-Marc.
Toby, totally changing tack. So we have almost done, and we have not spoken about wine. So I'm joking for a second, but you have seen like 10 to 15% of our listeners are thinking the environmental risk is actually important.
Can we just bring up the risk list?
So if you're in Bordeaux and you think that the Gulf Stream is going to weaken, you should be absolutely scared of what is your future as a chateau.
Yep.
So I'm joking about, whether it's Transmontane in Canada that could not find backers.
Yes.
So the state had to step in and buy the project to make it happen.
Yeah.
Everywhere, environment risk, and I'm not talking about the next storm, but I'm really thinking stranded assets.
Yeah.
I'm thinking infrastructure that cannot or can be developed. This is a massive shift into our realities.
Yeah.
Whether you believe in it or not, but it's not just global warming. It's pollution. It's species. It's plastics. There's so much happening at the same time. We had at ICMA 50 year in Madrid, we had Margaret Kittle from the WWF present everything in one place, 10 minutes keynote, extremely powerful. But it's not just about global warming. This is very narrow.
Yeah.
It's everything at the same time. And the changes that will come, you need to think, that's where the TCFD and Article 173 and all this all the good work we do on green.
Yeah.
How is it impacting your company or your asset management or your issuance or what we do every day? You need to think through, and it's not today, but it's pretty much tomorrow. It's not in 10 years' time.
The key question is really, are you as investors, are you beginning to de-risk according to vulnerability to the environment? Are you doing that yet?
I wouldn't say de-risk is the right word. We are absolutely taking on board environmental issues, stranded assets, environmental and social governance. But the one thing about the three of us, so to speak, is we are all very long-term investors. I mean, your longest bond is, forgive me, 50 years?
A little bit over 50 years.
50 years.
27.
You are certainly investing, as we are, stakeholder-type pensions for people who are going to be living 90, 100 years. So on that list here, most of the issues are actually very short-term. The end of Pax Americana and environmental risks are absolutely major issues for us to be thinking about as long-term investors. What's the correct strategic asset allocation for someone arbitrarily aged 20 today is an extremely important issue. And several of those points down there are absolutely fundamental. So the whole stranded assets debate, what percentage of my assets should I be putting into old-fashioned fossil fuels, 0 or 5? It's very important for your strategic asset allocation.
And I think climate change, it is a priced factor. It's it's a factor which has a negative premium associated with it. And some of the work that we've done in this space is to look at, we actually have a climate aware fund and a standard developed market equity fund. And the research we did looked at how climate news affected both funds. So you could actually see on days where news comes out which funds perform best. And one of the interesting things that we observed was that days where there's no news, there's no difference between the performance of the two funds. on the days where there is news, the climate aware fund performed better. So clearly the market is taking these effects into account. But what you see is that the standard fund doesn't catch up. So over time, you get a positive effect from this negative risk premium associated with stranded assets, with business models which aren't consistent with a 2-degree rise in global temperatures.
Yep.
And I think this is an interesting issue in as much as it has a different generational beta, if you like. So the older you are, the less time there is for these long-term factors to play out. So it's a vital issue, I think, for younger investors, for younger savers. But for older savers, the volatility of US election cycle, European election cycle, things like that may swamp these more meaningful and important issues.
Okay, so we're eating into the coffee time, if that's not a slightly mixed metaphor. We have to finish, but I think one very, very, very quick question. Otherwise, we shall go straight into coffee. Any quick question for our panelists?
I have one more risk if you want.
Hang on.
But, you know,
We do. We have one question, do we? No. No, I think, you know what, I'm getting the evil daggers from my colleagues that we have to finish. So, ladies and gentlemen, thanks so much for being here. Thanks so much for listening. Will you thank me, or will you join me in thanking my panelists? Thanks very much.